Hello there, Maverick traders. Welcome out to your trading room. This is in preparation for the week ahead, which will be September 11th through September 15th. And let's jump into it. So here's what we're going to cover. As always, the news of the week, what's been happening, why are markets moving the way they are. We'll score the markets from a broad perspective, S&P, NASDAQ, and so forth, on down to sectors. Give them a score and figure out which sectors are best for new trade ideas, like we've been emphasizing energy on the long side. And then we'll have some new trade ideas.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, so what was causing markets to move? Well, we gave up all of last week's gains, and we kind of warned as such that there were really big mixed signals. While the markets had gone back above the short-term moving averages, we talked about those short-term moving averages were sloping downward, the 20s below the 50. It was just a mixed bag, and so really we had a zero outlook. Just as quick as we rallied up 2 weeks ago, we gave it all back this week, and that's what a zero outlook is. Spinning your wheels, but really going nowhere. Economic numbers are still stable. This week we got ISM Services PMI, which beat pretty handily, 54.5 versus 52.5 expected. There was news that hit Apple, and Apple's the largest market cap stock. So, of course, as Apple goes to a certain extent, so goes the markets. Well, China's trying to move away and curb use of iPhones, and obviously that's a big growth component and possibility that that can really negatively hit Apple's top and bottom line. So it's not the most important thing in terms of their business. Certainly the U.S. market is much bigger, but if China gets away from Apple products, that is a very big negative for Apple on a revenue side and, of course, on the earnings side. So as we look at this past week, RBA kept rates unchanged. Bank of Canada, same thing, kept rates unchanged. U.S. data, it was pretty light. We saw initial jobless claims come in a little bit better than expected, and like we talked about, that ISM beat. Now, last week's trades, we highlighted a few different ideas. BKR, which is an energy stock, this bullish, and it went a little bit higher, although on Friday did give back a little of the gains. Match Group, we highlighted this as a possible bullish to neutral idea, and it's neutral, I would say. Trading neutral much more than bullish, but we still are essentially in this high basing pattern. So the possibility for further upside still exists, certainly, even though those moving averages have kind of gone sideways here. SPG, we highlighted this as a bearish trade idea. It spent the week sideways to slightly higher. And then last but not least, UPS, we highlighted as a bearish trade, and that was spot on. That stock got hammered. It was down pretty much every day, and even on Friday finished down there near the lows. So UPS, certainly the best of the bunch in terms of making a directional move and really going. So as we look at the markets, we talked about this kind of helter-skelter market. Well, 2 weeks ago, we had a nice rebound. This past week, we gave it all back. Dow down just under 1%. S&P, NASDAQ, the Russell 2000 real laggard, down 3.6%. Oil up again, up 1.79%, and gold down 1%. As far as these charts are concerned, it really doesn't change anything from last week. Last week we talked about, can you really trust this rally? Look, the 20s below the 50, some downward or sideways slope to them. Well, now we've come back below. It is slightly, I'd give just a very slight edge maybe to the bears, because you could say, well, now we're back below the 50, the 20s below the 50, and maybe we get some further declines. Possible. Right now we're still in more of that zero, though, with a slight bit touch more of bearishness. QQQ, same thing. We rallied above the moving averages. Now we've rallied back below, and we're figuring out where to go from there. Volatility index, a pop and then a drop. Popped early in the week as the market sold off, and then late in the week as the markets came back in, the volatility went away, and we're back at the lows. Now, why is the VIX down here at multi-month lows? That's the market telling you they think that volatility or price movement and those things, that basically the market's tired. They're not expecting that there are any major shoes to drop. When you're pricing a volatility index at 13, that means stability. That means don't expect a lot of movement. That's what the market's suggesting. Now, we have to find spots where maybe the market's wrong, but that's what the VIX is suggesting at current prices. Our outlook, we're still in this mixed signals formation, so I don't think it's really changed from last week. We said, well, you can't really trust that rally. This week, we'd say, well, you can't fully trust the decline either. So September is historically a bad month for stocks. Usually, there's the old sell in May and go away, right? From all of the market gains are basically from Halloween. Once you get out of October through to May, and then you sell in May and you re-enter on Halloween, and that's kind of the long-term history of the markets, is that seasonality, usually the worst period is right here in the fall, September, October time frame, and that's what we've moved into. So that doesn't mean that this year has to be bad. I would say that once you get past September and October, the markets look better, because whenever you have a stronger market and then you get late in the year, if the market's still strong and it's still up, there will be some money printing into the end of year. You'll get a scenario where people will start to chase the markets. They will not want to be left behind. If they're underperforming as a fund manager, they'll feel the need to go and chase into markets. There's also taxation. You don't want to sell your big winners. You want to delay that into the next year, so there's not a lot of tax harvesting in a strong year. So if the markets can stay relatively stable here for the next couple of months, it does set up for the possibility, generally speaking, that you get a nice finish to the year when in years that the stock market is up. Markets expect the Fed to blink. Inflation is not back at the target. Remember, the Fed's target is 2%, but future rate hike expectations have come down sharply in the last little while. Well, that could be a huge policy mistake if the Fed goes on hold and they never quite get inflation back. But the Fed seems to be blinking a little bit. That's what the markets are expecting. That's what they've been pricing in the last couple of months as the markets rebounded and rallied back up. So in the week ahead, we've got CPI and, of course, inflation. This gets to price stability. The Fed, two mandates: price stability, keep inflation in check, and full employment, right? So this is the one they've screwed up, and this is the bigger concern. They're willing to have some unemployment if it means getting price stability back, no question. And so this CPI number, where will it come in? Well, it's expected to come in at 0.6, which would be a little bit higher than the prior number and a little bit of an uptick back up in inflation. Expectations for the year over year number to go back up to 3.6. So again, is this where the Fed is watching? Is this why they're still going to need to hike more? This inflation number will be watched closely. And again, that's Wednesday morning before market open at 8:30 a.m. Eastern time. You get core PPI numbers and some retail sales on Thursday. Retail sales have really been hammered of late. You can see here expectations are last month 0.7%, this month 0.2%, and all the retailers are complaining about it's a big deal, these organized crime situations where people come in and just rob the stores blind. And Lowe's and these other businesses are talking about it being $1 billion worth of losses just in terms of the stealing and things that are happening. So it's a big problem. There's these organized crime areas where they're getting hit massively. And so some places like San Francisco and some others are just simply shutting down. The stores are saying, we're not making any money. We've got to get away from here. It's just too bad. So we'll see how that continues to progress. But retail sales, certainly if there's an area of weakness, you're seeing that in retailers of late. So monthly outlook, still kind of at that zero. Little bit of a give back. So now you'd say, well, we're above the 20 but below the 50 now, whereas last week we were above them. Still sideways sloping. It's a mixed bag. It's a mixed picture. No reason to make a big aggressive analysis on the markets and real strong opinion that way. For sectors, there were two sectors that were up. One made perfect sense. It was by far the best sector. We highlighted it as a +3. The other has been the worst sector. So why did it bounce back? I'm not sure I fully understand. It was more of they just sold off so hard for so long. They finally got a bounce back at the end of the week. So everything else was down. Industrials down 2.9, consumers down 2.9, materials down 2.4. It was a bloodbath to a certain extent in most sectors. That might be overstating it, but certainly a bad week. Now, utilities, as we said, bounce back, but still in a little bit more of a bearish price pattern, coming back up to these prior lows. Give a little bit of credit in that while you're still below all the moving averages and in a downtrend, it was the strongest sector for the last 2 days of the week. So can we rally a little bit further? Certainly possible. We'll see. Still very bearish looking chart. Communications, this one has been above the moving averages, has stayed above the moving averages. It's worth a little bit added bullishness just because it's a little bit better than the S&P and the Nasdaq and these other markets. Communications a +1. Real estate, this one finished back below the 20, had been in a little bit of a rebound, but again, just still downward trending. So -1 in real estate. Everything else is pretty much more bearish or more neutral. I think industrials, we could go back to a -1 here. You can see we've gone back below the 20, below the 50, and really rough week this week. So we went ahead and downgraded it a little bit, -1 for industrials, and starting to look a little more bearish, certainly a little bit weaker here back to those lows. Next, we've got healthcare. Again, a little bit more bearish than other sectors. We've broken some support here. All the moving averages are mixed up, but we'd have to give this more of a -1 variety. Definitely a little bit underperforming. The rest of these, mostly zeros until we get to energy. So financials, that's just a big mess. All bunched together, all going sideways. Financials at more of a zero. Consumer stocks, again, I've got it at more of a zero. Mixed picture, above 20, below 50, bouncing around those, sideways sloping and such. Technology, same thing. 20 curling up, 50 sideways, below 50, above 20. It's just hard to make heads or tails of it. Materials, same thing. Just a mixed bag of messiness. Energy's been by far the stellar outperformer. The only concern would be that obviously it's been so good for a while now, and it's really been the bullish sector for some time, just over and over again, that maybe at this point it's getting in need of a little bit of a correction, maybe a little bit of a down week or something like that. But I wouldn't try to overthink it too much. Continue to add into energy. Look for opportunities, look for stocks within that sector. It still is the best of the bunch. So much more in that +3 category. As we look at the sectors, a little bit of a downgrade for a few of these, industrials and healthcare. Everything else pretty much in that zero range. Energy by far the best performer in the sector that I've liked to trade the most the last little while. I don't trade a lot of utilities. I find them to be quite boring and such. So even though utilities are moving some, I haven't really focused on that sector in any way. Now, some possible trades. Healthcare sector, we were looking at Pfizer, definite breakdown. We downgraded the sector a little bit. And you could wait for this to have a little bit of a bounce as possible, or just enter this trade. But we were looking at bear call spreads. Sell a 32.50, buy a 35, expectations that it just continues to bleed a little lower, and you bring in a big credit for that, good risk to reward, that sort of thing. So Pfizer, possible bear call credit spread idea. Consumer stocks were on the list. So here is one we like. Marriott, you can see, has been in a little bit of a corrective phase. And whether you call this a triangular type of pattern, a little wedging pattern, we started to break out at the end of the week. Marriott, I like as a 205, 210 bull call spread in the October 20th monthly time period. All you're really betting is that it can get back up to 210 and higher by that time. And this looks like an outperformer. It continues to outperform sector, market, relative strength, all those characteristics that we look for. So Marriott, much more bullish. Hilton, some of these other names were very much in line with that. Materials, ADM, Archer Daniels, Midland. You can see some bearish crossovers happening here, some recent breakdowns, and this one we'd expect to continue to go lower. A 75-80 bear call spread. Expectations are that you'll finish down here sub 75 by October 20th expiration. Archer Daniels Midland definitely acting bearish and looks like it can continue to trade lower. And then last but not least, energy. Got to add one more bullish trade, which is keep layering on more and more. Here I'm going to go out a little bit further in time. We might see a little short-term pullback or something like that, but going out to November, a couple of months out, and going out of the money with a targeted call butterfly. So the target would be 72.50, which is off the screen. This is an excellent, excellent risk reward probability mix. Your reward will be much higher than your risk. Your probability is low that you will land at 72.50 on expiration Friday, but it's high enough that you could go up and touch that. And generally, if I were doing a targeted butterfly like this, I would set maybe a conditional order or whatever. As soon as the stock goes up to 72.50 or higher, touches that level basically, I could take this trade off, and it would probably, depending on how soon it happens, the later it happens, the better. So if it happens immediately, we might double our money. If it happens closer to November 17th expiration, we might triple, quadruple your money, that type of thing, if you were close to expiration. But anyhow, good risk to reward, $5 wide butterfly, and that's one that is not a short-term trade. You'll be sitting in this for multiple weeks, but if it can continue to work its way higher and ultimately towards 72.50 by later on this year, that would come in very, very nicely. So Oxy, this is a Warren Buffett, Berkshire Hathaway favorite, little mini cup with handle, if you want to call it cup and handle, an ascending triangle. Any way you slice it, it still looks and acts bullishly overall. In conclusion, markets haven't really changed much in the past week, still more neutral. Continue to focus on sector strength and weakness, look at little areas to add to different stocks or different sectors that are working. And as always, do more of what's working, do less of what's not. Continue to trade the markets in front of you. Have a great week, and we will see you next time. Goodbye, everyone.